Let's welcome in Ajay Bagga. Ajay, are you surprised by the move in the market, especially after the budget? There was no particular reason to cheer, but do you think markets are just rewarding the fact that there was no negative news flow?
Absolutely. The markets had been, driven into such a corner on expectation of something on long-term capital gains and as well as some other things in the budget which did not materialize. The fiscal deficit a projection came in at 3.2% for this financial year, for the next financial year. So I think those were the two big triggers which led to a relief rally, a lot of short covering as well that we saw. So a bear trap was set up to some extent, especially in banking. Banking has been the most surprising factor. Some changes by RBI in the Basel requirement and the bonds, 81 bonds treatment. And we saw the public sector banks taking off. Normally, when Mr. Jaitley announced only 10,000 crore capitalization, which was as per plan, we thought there would be a sell-off in the public sector banks. But this was a big surprise because of the change RBI brought in. And I think the AQR also, they will now defer and allow banks to be a little more liberal in terms of provisioning. So I think all those things are adding up for this bank rally, which is really leading this market up.
Right. What Q3 results, which also have been declared, a lot of companies have declared, are they better than what the anticipation was?
Yeah, Pankaj, and if you see, a big change in the Indian markets is just like the US markets, we have started discounting away the year-on-year, and we are looking at more the street expectations. So you had a pharma major reporting last week. It was 16% year-on-year degrowth, but better than street expectations. Same with the two-wheeler major, worse than last year, but better than street expectations. So our market is moving more towards this kind of flavor, where we are really not looking at the year-on-year, and we are going more by the street expectations, which were driven a lot down. After demonetization, the analysts were really very pessimistic. Some analysts had even talked about the GDP growth halving to 3.5%. All that has not come true. So we are seeing a relief rally happening. Second big macro difference is the way the US authorities have talked down the dollar. And the weakness in the dollar is contributing to EM flows reviving. As you would have seen the news flow, 2,300 crores coming in terms of FPI flows into our markets in the last 4 or 5 days. All that is helping overall. So it's a market which is driven by liquidity with fundamentals which have not deteriorated as much as we had thought. I would sum it up like that.
Right. As far as the earnings overall are concerned, if earnings are not as bad as it was feared even in Q4, do you think markets still has a leg to go up?
Market definitely has a leg to go up. And if you look at it in a little longer range, Pankaj, in first week of March 2015 was the previous lifetime high of the market. We are within striking distance, roughly about 3.5% from that level. So it's been a huge time-wise correction. 2 years, the market has really not given any returns. Individual stocks have done very well. Funds have done very well because of active alpha management. But the overall markets have really not gone anywhere. Mid-caps have today hit their 52-week highs. So I think this momentum has the legs to carry the market further, and it won't be a big surprise. It's an underperformed market for the last 2 years. It's really not performed that much. Within this year, I think this market then gives much more than the 18% which the street is expecting. You're probably looking at a 30% kind of a return from this market, having seen what January has really delivered and the kind of momentum. And if the UP election goes to the BJP, I would hazard to say then this market gets rockets under it and just starts shooting up.
Right. The point that you made, for 2-3 years, markets have not gone anywhere, but emerging markets have done essentially quite well. That tells you that India was an underperforming market, and now with positive news flow coming in, or no negative news flow coming in with key events, markets is playing a catch-up role?
It is a catch-up, and if you look at the flows-wise also, the domestic flows have really put a good bottom under the market, Pankaj, because otherwise we were very dependent on the FII flows. So we saw negative flows last year for 3-4 months, but the domestic inflows gave some kind of a bearing to the market. So overall, the earnings are better. Over the last 2 years, we have done some growth in the earnings, and the anticipation is that now going into the last 2.5 years of this government, the things start hotting up a lot, and a lot will be determined by the state elections, as I mentioned earlier. That could really see a very determined government come in and start really ratcheting up on the reforms front. That's the anticipation.
Right. Ajay, the state election results are still some time away, and we still will wait to watch what really happens. But the next trigger is going to be the RBI policy, which is this week itself. Last time we saw status quo, and now again the opinion seems to be of status quo. Is that going to be a spoil sport? Because banks are flush with money, and you said that earnings are better versus estimates, but really from a year ago they're just okay. They're not showing strong strength. So to revive growth, do you think the RBI can look at a rate cut at this point of time?
Yeah, it's a very good point. In fact, we were discussing that, Pankaj and I, before the program. Overall, 3 points here. Whenever there has been fiscal restraint, we have seen RBI coming in and rewarding with the monetary stimulus. So because of that, the street is still anticipating a 25 basis point hike. Despite the base effect and everything, we feel that the inflation will stay moderate. This is probably the only time when RBI can go ahead and cut rates. As the Fed starts accelerating its rate hikes, there won't be too much monetary space left. The second big part is that the banks have already started transmitting the rates down because of the liquidity. I know in the busy season in Jan to March, normally we would be negative liquidity about 1% of the demand time liabilities. We are flush with about 350,000 crores of excess liquidity despite an MSS of nearly 550,000 crores. So a huge liquidity based on the demonetization is sitting in the banking system, which has still not led to much lower rates. So the banks, RBI could come in on 8th and say, it's up to the banks. The overnight rates are in the 6.5 range. Why aren't you bringing down the MCLR-based base rate lending? That should come nearer to 7.5 now. So you could have a commentary like that. So even if RBI does not reduce rates, the banks have scope to reduce rates by about 1% based on the liquidity scenario. The third big part is what does the Monetary Policy Committee think? Are they looking at only inflation targeting, or will they look at some part of growth regeneration also, what you were mentioning? That is much needed. There is no credit growth in the economy. The SME sector especially is getting constrained by the demonetization impact till they change business models to move totally to the formal channels and to the banking channels. So right now banks have a role to play. The market is always right. Market has moved ahead of the actual fact. Now let's see what happens on the 8th. But 25 basis points are very much discounted in this level of the market. So if there is no rate cut, there is a correction in the banking stocks that you can see on the 8th.
All right. So if somebody has a long-term view, would you then suggest that people look to buy some of these financial names, maybe not banks, maybe housing finance majors or NBFCs? The markets have moved up quite a bit. If there is a correction, will that offer a buying opportunity for these kind of names?
No, definitely. Private sector banks will be the biggest beneficiaries. We feel this is going to be a cyclical year. So autos, financials, all rate sensitives will really lead this market up. So it's a good time to buy private sector banks. Public sector banks, I'm not so convinced, especially the kind of rally that's happened. That's been more on the base of the budget and RBI giving some leeway to the banks in terms of accounting, both for Basel accounting as well as for provisions and the tax accounting. Nothing is fundamentally changed. These banks are losing market share hand over fist. Vijaya Bank did give a good result based on good retail lending, but we are not seeing that with most other banks. So I would be wary of public sector banks. I would say private sector banks, housing finance companies, huge beneficiaries of the affordable housing, infrastructure move, they will be beneficiaries. And NBFCs, again, we are seeing a return in the microfinance. We have not really seen very poor impact of demonetization, which has been a good, pleasant surprise. Looks like a V-shaped recovery. Remember, in terms of notes coming back into the economy, we were at 17.5 lakh crores as of November 6th, which is the last data before the November 8th demonetization. And as of Jan 27th, which is the latest RBI data, you are at 9.6 lakh crores. So only 60% notes have returned, and the economy is doing pretty fine. So that means that a lot of the other notes were really lying idle. But the benefit is 8 lakh crores extra has come into the banking system, which is benefiting from the money multiplier, which will lead to a good tailwinds going ahead for the economy. So I would say financials is a good way to play this trend, and you can load up on financials on every dip.
Right. Ajay, I know you cannot talk about stocks and specific stocks, but, financial is a very big space. Within financial, let's just first look at the banks, and then probably we'll talk about NBFCs. Within banks, do you like private sector banking names which are emerging as very big in retail, or, something which continues to deliver good numbers and will continue to deliver good numbers? How would you look at the private and the PSU banking space?
Yeah, so private above PSU, I would say probably the top 3-4 PSU are worth looking at. The rest need to be merged into the bigger banks. Standalone, they are just not there. They don't have capital. They don't have presence enough to make a mark. So probably 5 PSU banks should be there with the mergers is how I would play it. So if there is merger talk again accelerating, post-April, then you can look at the PSU banks. Again, stick with the top 4-5. Private sector banks, what we like, both the emerging private sector banks, which have really done well, except some of the new banks. Second would be the retail-focused ones. The corporate-focused ones, market is really living on hope. There is no turnaround yet. And there are still in terms of slippages, if you see, there are very disappointing levels of slippages for the corporate focused banks. So it's been more a bounce based on extreme pessimism that we are seeing, just like the public sector banks. You're not rewarded well enough by these corporate based banks. I would say stay away from them. Private sector banks, emerging, smaller, well-run banks. Second, the retail-focused ones. These would be the two topics.
Right. Just a word on the corporate sector banks. If you expect money to come back soon, rolling to start happen soon, basically remonetization to start to have an impact. Don't you believe economy would pick up and these corporate sector banks could do well? Or are you worried about select exposure that a lot of ththese banks have?
It's a select exposure which has been managed with a lot of finessing. So, at 12-14% kind of stressed asset base. And, when RBI brought in various measures over the last 2 years, one thought they could take over the managements and manage these banks. But look at the, big conundrum. You were ready to lend 4 times, 5 times net worth to these companies for projects, but you are not willing to take over these managements and try to turn around the companies. So if you didn't believe in these companies, why did you lend so much to these companies? And why should I, as a shareholder, trust you with my money when the same managements are there, the same CEOs come on TV and give you all kinds of speeches which they don't really believe in? I would say stay away from the corporate focused banks. It's just not worth putting your money into that.
Right. As far as PSU banks are concerned, Do you believe that a lot of them, or at least some of them, could do well, especially the large ones which are well capitalized?
The large ones will do better. The government will probably go for mergers. Those should accelerate. You don't need so many PSU banks. Even in terms of footprint, the footprint has to move out of urban areas into rural underbanked areas. You see any main street in India, in any of the towns, you would find 6, 7, 8 public sector bank branches, about 20 ATMs. You just don't need that. It's a national waste that we are doing. Cut it down to 5, 6 public sector banks with mergers, which are then of good scale, and they have a good chance with good amount of capital to really grow. Otherwise, PSU banks will continue to lose market share to the well-run private sector banks, as well as to the shadow banking area, the NBFCs.
Right, but how should one identify the PSU banks? I know it's a very tough question, but how would you look at it? Companies which have sufficient capital, which don't need dilution, or companies which would potentially be takeover targets? How would you essentially look at PSU banks before you make a basket?
Yeah, very good question. I think you'll get the highest returns from the ones who will be targets, because the market will bid up just before the announcement. So it's a very difficult cause to go and pick those up, because we don't know unless somebody has some informed information from the inside. Normally you won't know. So I would say play it 2 ways. The safer way is pick the top 5, 6. You're pretty safe in
the large
that
ones.
sense. The large ones, by just the sheer size of revenue and capital. The other ones will get merged in. So those are a longer term, by 1 year, 2 years basis. You can go ahead and keep those on your portfolios, hoping that the merger comes through.